What if building wealth was simpler than you think? Forget the noise. This is about building an empire, one unstoppable stock at a time. These aren't get-rich-quick plays. These are fortress balance sheet companies essential to our lives, built to endure. This is the foundation of a portfolio that endures. Are you ready? Let's get this show on the road. The anchor of our portfolio is Eli Lilly, ticker LLY, a pharmaceutical powerhouse and a true cornerstone investment. In a world of uncertainty, medicine is a necessity. Eli Lilly's products are essential, creating steady, recession-proof demand. With an aging population and constant innovation, Eli Lilly stands strong, serving a fundamental human need, now and for decades to come. Let's talk about the moat. In investing, a competitive moat is the secret sauce, the invisible barrier that keeps competitors at bay and protects a company's profits. Eli Lilly's moat isn't just wide, it's a multi-layered fortress defended by legions of lawyers, scientists, and regulators. First and foremost is its patent protection. When LLY develops a new drug, it's granted a period of exclusivity where no one else can legally sell that same compound. This creates a temporary, government-sanctioned monopoly, allowing the company to recoup its massive R&D investment and generate enormous profits. It's like owning the only bridge into a wealthy city. But the moat doesn't end when a patent expires. The second layer is the sheer complexity and cost of drug development. We're talking about a process that can take over a decade and cost billions of dollars, with no guarantee of success. A smaller company simply can't afford to play at this level. Eli Lilly has the deep pockets, the global infrastructure, and the institutional knowledge to run dozens of these high-stakes projects simultaneously. They can absorb the failures and capitalize on the winners. A scale advantage that crushes smaller would-be rivals before they even get started. Then there's the regulatory hurdle, the FDA. Getting a new drug approved is an arduous, data-intensive marathon. Eli Lilly has decades of experience navigating this bureaucratic labyrinth. They have established relationships and a track record of safety and efficacy that gives them immense credibility. A new entrant doesn't just have to invent a drug. They have to prove to the world's toughest regulators that it's safe and effective. This regulatory wall is a massive barrier to entry, filtering out the pretenders and ensuring that only the most serious, well-capitalized players can compete. Finally, consider their brand and relationships with doctors. Physicians are creatures of habit and trust. They prescribe the drugs they know, the ones backed by reams of clinical data and produced by a reputable company like Eli Lilly. This established trust and distribution network is incredibly difficult for a competitor to replicate. It's a sticky ecosystem built over a century. So you have patents, immense scale, regulatory expertise, and a trusted brand. That's not just a moat, that's an ocean. Booyah! That's a business you can bet on for the long haul. Let's pop the hood on Eli Lilly. Their blockbuster drugs drive consistent revenue growth, with margins near 80%, true financial muscle. This profitability fuels innovation and rewards shareholders with a growing dividend. Managed with discipline, Eli Lilly is a financial fortress built for the long term. Now, no investment is without risk. If anyone tells you a stock can only go up, you grab your wallet and you run for the hills. Even a titan like Eli Lilly has things we need to watch. The single biggest risk for any major pharmaceutical company is, without a doubt, the patent cliff. This is the day when the patent on a blockbuster drug expires, and the floodgates open for cheap generic competition. When that happens, sales of that drug can fall off a cliff, dropping 80 to 90% in a very short period. It's a brutal reality of this industry. Eli Lilly has faced these cliffs before and will face them again. The key is whether their R&D pipeline can generate new blockbusters to replace the revenue from drugs that are going off patent. Right now, their pipeline looks absolutely spectacular, with Mounjaro and Zepbound looking like two of the best-selling drugs of all time, but we must remain vigilant. The success of their future depends entirely on their ability to continue innovating at an elite level. Any signs that the R&D engine is sputtering would be a major red flag for the long-term thesis. Another risk is regulatory and political pressure. Pharmaceutical pricing is a political hot potato. There is always pressure from governments and insurers to lower drug prices. Eli Lilly continues to stand out as one of the most powerful growth stories in the healthcare sector, driven by strong demand for its innovative drug portfolio. The company currently commands a market capitalization of approximately $930.88 billion and trades at a price-to-earnings ratio of about 50.78. Earnings per share sit at $20.45, reflecting robust profitability. In 2024, Eli Lilly generated roughly $45 billion in revenue and delivered net income of about $10.59 billion, highlighting both strong top-line growth and impressive margins for a large pharmaceutical company. While LLY provides immense value, the high cost of its innovative medicines is a constant point of contention. A major shift in legislation in the United States, their largest market, could potentially squeeze their margins and impact profitability. We have to acknowledge that this political risk, while often just noise, could one day become a real headwind for the entire sector. So, how do we get comfortable with this? We recognize that these risks are known, they're manageable, and they are more than priced into the long-term opportunity. The strength of LLY's current portfolio and pipeline provides a massive cushion to weather future patent expirations. And while political noise is constant, the fundamental need for innovation remains. But this calculated risk in a defensive name is exactly why we don't put all our eggs in one basket. It's why our next stock will add a different dimension to our portfolio, a dimension of explosive upside. Okay, we've laid the foundation with our fortress, Eli Lilly. Now it's time to add some firepower. Before we do that, hit the like button, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. It's time to add the upside engine to our portfolio. I'm talking about a company that is a pure play on the aspirations of the global consumer, a premium brand that is synonymous with quality, trust, and success. Buckle up, because we're talking about the one, the only, American Express, ticker AXP. If LLY is your defense, AXP is your all-star quarterback, capable of putting huge points on the board. This is the growth component that can turbocharge your returns over the next decade and beyond. The big opportunity here is simple, but massive. The ongoing, unstoppable global shift from cash to digital payments. You might think this trend is old news, but you'd be dead wrong. We are still in the early innings of this game, especially in developing economies. Cash is still king in vast regions of the world, but it's a king whose throne is wobbling. Every single day, more people are getting bank accounts, more merchants are accepting cards, and more transactions are moving online. American Express is perfectly positioned to ride this colossal wave for decades to come. What makes AXP so special in this space? It's their unique closed-loop model. Unlike Visa or MasterCard, which are just payment networks, American Express is both the network and the lender. This gives them a treasure trove of data. They see what their card members are buying, where they're shopping, and how much they're spending. This data is gold. It allows them to offer targeted rewards, build better products, and most importantly, manage risk with a level of precision that their competitors can only envy. They know their customer inside and out. This is not just a credit card company, it's a premium lifestyle brand. People don't just use an Amex card, they are members of a club. It's a status symbol, a statement that you've arrived. This powerful brand identity allows them to attract high-spending, high-credit quality customers who are less sensitive to economic downturns and more loyal to the ecosystem. This premium focus is their secret weapon, insulating them from the cutthroat, low-margin competition at the bottom end of the market. They're not playing the same game as everyone else. They're playing in a league of their own. Let's dig deeper into that product advantage. The American Express card isn't just a piece of plastic, it's a key that unlocks a world of perks. We're talking about airport lounge access, hotel upgrades, exclusive event access, and a level of customer service that is legendary. These benefits create an incredibly sticky ecosystem. Once a customer gets used to the Centurion Lounge, it's very hard for them to go back to waiting at the gate with everyone else. This is how Amex justifies its annual fees and builds a fanatically loyal customer base. This focus on the premium consumer is a structural tailwind in itself. Globally, the middle and upper classes are expanding. As people become more affluent, they travel more, they dine out more, and they spend more on discretionary goods and services. Who captures that spending? American Express. Their entire business model is built to cater to this exact demographic. They are a direct beneficiary of rising global prosperity. While other lenders fight over subprime borrowers, Amex is happily serving the most profitable and reliable segment of the market. It's a brilliant strategy. American Express represents a more mature but highly resilient business model within the financial services space. The company carries a market capitalization of approximately $253.85 billion and trades at a price-to-earnings ratio of around 24.48. With earnings per share of $14.90, American Express continues to demonstrate pricing power and customer loyalty. In 2024, the company produced total revenue of about $65.94 billion and net income of roughly $9.99 billion, underscoring the strength of its premium cardholder base and its ability to perform well even in uncertain economic conditions. Now, for a curiosity reset, you might be thinking, what about all the fintech disruptors? What about Apple Pay, Block, and all these new kids on the block? It's a fair question, but here's the thing they miss. These new technologies are not competitors to Amex. They are new distribution channels. When you add your Amex card to your Apple Wallet, who gets paid on every transaction? American Express. These technologies are making it even easier and more seamless to use the existing payment rails, which only strengthens the position of incumbents like AXP. They are riding the wave, not fighting it. Think about their competitive positioning. Visa and MasterCard have a scale advantage in terms of sheer number of cards and merchants. But American Express competes on quality, not quantity. Their closed-loop network gives them data and risk management advantages. Their brand gives them pricing power and customer loyalty. They have carved out the most profitable niche in the entire payments ecosystem and have defended it for decades. They aren't trying to be everything to everyone. They are focused on being the absolute best for the best customers. That focus is their power. All right, let's be honest about the risks. American Express is not a pharmaceutical company. Its fortunes are tied directly to the health of the global economy, and more specifically, the spending habits of consumers and businesses. When a recession hits, travel and entertainment spending is one of the first things to get cut. This makes AXP a more cyclical stock than a defensive name like Eli Lilly. A severe economic downturn would absolutely impact their revenue and earnings. We have to go into this with our eyes wide open. This is why it's the upside engine, not the bedrock. The other major risk is credit risk. Because Amex is a lender, they are on the hook if their card members can't pay their bills. Now, they are masters of managing this risk. Their focus on premium, high-income customers means their default rates are consistently among the lowest in the industry, but they are not zero. In a deep and prolonged recession with widespread job losses, even affluent customers can fall on hard times. An unexpected spike in credit losses would hit their bottom line directly, and the market would punish the stock for it. So, how do we reframe this? We see the cyclicality not as a bug, but as a feature. The best time to buy a world-class cyclical company like American Express is when everyone is terrified of a recession. The market often overpunishes these stocks, throwing the baby out with the bathwater. This gives long-term investors a chance to buy this incredible franchise at a discount. We understand that there will be economic cycles, but we are betting on the long-term upward trend of global spending, which is one of the surest bets you can make. And let's compare this to our anchor. Eli Lilly provides stability. Its demand is inelastic. American Express provides growth. Its demand is elastic and tied to prosperity. LLY is defensive. AXP is aggressive. LLY protects your portfolio in a downturn. AXP accelerates it in an upturn. See how they work together? They are two different tools for two different jobs, but both are essential for building a truly unstoppable, all-weather portfolio. You get the steady compounding of the tortoise and the explosive potential of the hare. That's how you build real diversified wealth. Let's talk about the growth flywheel that makes AXP so powerful. It starts with acquiring new, high-quality card members. They do this through savvy marketing, corporate partnerships, and the sheer power of their brand. As they add more high-spending members to their network, the total volume of spending on their cards, what they call billings, grows. This is the top-line fuel for the entire machine. More members spending more money equals more revenue for American Express. It's a simple, beautiful equation. This increased spending then makes the American Express network even more attractive to merchants. Merchants want to be where the big spenders are. Even though Amex charges merchants a slightly higher fee than Visa or MasterCard, merchants are willing to pay it to get access to Amex's affluent customer base. This creates a virtuous cycle. More card members attract more merchants, and more merchants make the card more useful, which in turn helps attract even more card members. This is a classic network effect, and it gets stronger with each new user. The fees from merchants and the interest and fees from card members then generate a river of cash flow. What does Amex do with this cash? They reinvest a portion of it back into the business to make the flywheel spin even faster. They enhance the rewards and benefits, making the card even stickier and more attractive. They invest in technology to improve the customer experience. They invest in marketing to acquire the next generation of premium customers, and of course they return a healthy chunk to shareholders through dividends and buybacks. This flywheel is a compounding machine. It's not just about one-time growth, it's a self-reinforcing system that builds on itself year after year. As long as they continue to execute this strategy, attracting premium customers, growing spending, adding merchant value, and reinvesting intelligently, the growth story has a long runway ahead. This isn't a company that's sitting still, it's a dynamic enterprise that is constantly strengthening its competitive advantages and expanding its reach. That's the engine you want powering your portfolio's growth. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. We've talked stability with Eli Lilly, upside with American Express, now meet Alphabet, ticker GOOG, the digital titan, the parent of Google, YouTube, and more. Alphabet is the backbone of the digital world. It's not just a stock, it's a portfolio of world-changing businesses. Search, AI, cloud, moonshots. Alphabet invents the future. Own GOOG and you own a stake in tomorrow. Google and YouTube are advertising juggernauts, printing oceans of cash. Their core business is a money machine. Ads appear just when you need them. With Google Cloud's explosive growth and moonshot bets like Waymo, Alphabet combines stability, innovation, and massive upside. It's the best of all worlds. The elephant in the room. Will AI dethrone Google? Here's what the bears miss. Google has been a pioneer in AI for years. They're not playing defense, they're on offense, integrating AI into everything. The real risk? Regulation. But even a breakup could unlock more value for shareholders. Don't fear. Embrace the opportunity. Alphabet remains one of the most dominant companies in the global technology landscape, with a massive market capitalization of approximately $3.98 trillion. The stock trades at a price-to-earnings ratio of about 32.61, supported by earnings per share of $10.13. In 2024, Alphabet generated an extraordinary $350 billion in revenue, while posting net income of approximately $100.11 billion. These figures reflect the company's unmatched scale, strong advertising business, and growing contributions from cloud computing and artificial intelligence, positioning Alphabet as a core long-term holding for investors focused on innovation and durable growth. Alphabet is the perfect blend. Stability like Eli Lilly, explosive growth like American Express. It's your anchor in tech's turbulent seas, and your ticket to the future. With Alphabet, you get both growth and value in one unstoppable package. Don't wait. This is your chance to own the digital core of tomorrow. Booyah! We explored Eli Lilly, American Express, and Alphabet, but this is bigger than stock picks. It's about building a championship portfolio for your financial freedom. Stick with us for more strategies, and remember, water your flowers, cut your weeds, and let compounding build your wealth. Now go out there and make some money. See you in the net one.